Okay, so you found a property that you think is going to work. You walked through it. The numbers make sense. So now it's time for the financing part of getting a property. So there are many different ways of financing a property. In fact, you can actually even mix and match some of them, which is a nice plus. Today, we're going to be talking about one in specific, one in particular, the Federal Housing Administration Loan. It is a government-backed loan. It does not stand for First-Time Home Buyers Assistance. Does not mean that. And basically what it does is it allows you to put 3.5% down on buying a property. Then you have to live in that property for a year, and then you can move out and then rent it to other people. Now, there are a couple pros and cons of doing this kind of deal, which, by the way, this is also considered traditional financing. You go to a bank and you can get an FHA loan. So there are a couple pros and cons. Con number one, the property needs to be in good condition. For the majority of us, you have to live there for at least 12 months. And the third one, con number three, there is something called PMI. Actually, technically it's not PMI because it's something else here. I'm going to look up the actual technical definition. Let me pull it up. A mortgage insurance premium means that if you don't own at least 20% of the home, you will be paying an additional cost. That will be tacked on top of the mortgage that you're already paying, the principal, the interest, and then they'll add this fee as well. It is a monthly fee until you own at least 20% or you refinance with some other kind of loan. What are the benefits of doing this type of deal since there are cons to it? Well, number one, it gives you easy access, easy entry point to getting the home. And this works on single family, so 1 unit, all the way up to 4 units. Great. Imagine, and this is what most people call house hacking. Live in 1 unit, you rent out the rest, and then eventually when you have at least 20% equity, you could consider also moving out, putting somebody else in there, and then doing the exact same thing that you just did, getting an FHA loan for the next property with 3.5% down. I will say, before you jump on doing this idea, that it's more likely that you will need to build 20% of equity in the home to refinance into another loan. So even though you got the property, even though you've lived in it for a year, if you don't have enough equity in the home, it's going to be really hard to refinance through another type of loan because most banks and most kinds of lending, whether it's traditional or unconventional loans, they will want you to have some kind of skin in the game, which typically is 20%. Oh yeah, one more pro about this is that actually it is the FHA loan is offered to a lot of people, even people with low credit scores. It goes as low as 580 on the credit score, and that's it. Cool. All right, so that's FHA. That's one of the traditional loans. The next video, we're going to talk about a conventional loan, kind of not, and we'll get into it next time. All right. Follow for the next one. Also, follow me, subscribe and stuff. And if you want more help, send me a DM.